The average investor, business owner or not, starts planning for their retirement at 52 years of age, which is just insanely late, right? I mean, there's not a single person I talk to who doesn't say that they wish they would have started earlier. Everybody says that.
Welcome back to the Retirement Fiduciary Podcast, a place where we have authentic, no BS discussions about retirement planning, investment strategies, and wealth management. Whether you're approaching retirement or if you've already made work optional, this show is for you. Now, here's your host, Adam Koós, President, Portfolio Manager, and Senior Financial Advisor at Libertas Wealth Management Group at libertaswealth.com.
Welcome into the Retirement Fiduciary Podcast. Producer Kyle here, just stepping in to do a quick intro for Adam. Our podcast this week is an appearance that Adam had on the Ideal Investor Show with Axel Meierhoefer recently. Interesting conversation, taught me a lot more about Adam's earlier days and sort of what set him down the path of becoming the wealth manager that he is today, and how originally he thought he was going to be a trauma surgeon. Had no idea. And then just some of the things that happened along the way that sort of pointed him in the right direction and has gotten him to where he is now. If this is your first time checking out the show, please rate and subscribe wherever you are, YouTube, Apple Podcasts, Spotify, and on with the conversation.
Hello, everybody. Welcome back to another episode of the Ideal Investor Show, where we bring you great guests from all over the country, experts that have to do and serve people for money, for investing, for growing their wealth and growing their cash flow. And today we have another great guest, Adam Koós is with us. Adam, welcome to the show.
Thank you so much for having me. I'm looking forward to it.
Yeah, absolutely. And I want to profoundly thank you for, I don't know if it was intentional or not, but getting up extra early to be here. So
I think it was just you're a busy guy and you've got a lot of bookings apparently. And then when I scheduled this, I'd much rather get up in the morning and get a whole lot more done than try to work it in the afternoon. But anyway.
Yeah, no, absolutely. I have realized that too. There's like a certain time before everybody else's business really get going where you really can focus. So appreciate it, Adam. Thank you. Before we dive into some topics around money and investing and stuff like that, please tell the audience a little bit, how did Adam become the person he is right now and get to do what you're doing right now? A little bit like your origin story, if you don't mind.
Yeah, sure. I'll try to give you the Cliffs Notes version. I grew up in Cleveland, Ohio, and watched my dad, who was a business owner, kind of run his optometry practice. And every day I would come home from school and I would stop at his office and I'd just kind of hang out with him and watch how he interacted with his patients and how much they loved him, and then how he interacted with his staff and how much they loved him, and just what a great business he ran. And from that, I don't know, very, very young age, I always knew that I wanted to own a business of some sort and be like my dad. Now, back then, I thought I wanted to be a doctor because, my dad was, and to this day, he's still my idol. He's the guy I've always wanted to be like. And after shadowing him for one day, at the end of the day, I felt terrible because it's like, you idolize your dad, you think he's the best thing in the world. And then he asks you, so what do you think? And I'm thinking, all day long, he's talking to 14 people and he's saying, is this one better or this one? What about this one? Is this one better? Looking at glasses and lenses. And I'm thinking, there's no way I could do this all day. I just couldn't do it. It'd be too much routine for me. And so I ended up going to Ohio State University for pre-med. So the plan was to do something in medicine. I didn't quite know at the time when I first got there. And after after a few injuries in TaeKwonDo, I was competing for Ohio State in TaeKwonDo. After a few injuries, I realized that trauma surgery was what I wanted to do. And I thought that sounded really fun, really exciting, different every day, lots of variety. And I actually worked at the Ohio State trauma room for 3 years as a volunteer. And then when I was competing at Ohio State, I had this huge goal of going to the Pan Am Games. And in order to do that, you've got to get first or second at nationals. And the prior year, I'd gotten third place at nationals. And I thought, okay, if I make it to get first or second at nationals, I get to go to the Pan Am Games the following year. And that would be kind of like, the bucket list item I could check off.
Yeah.
Instead, I ended up having a career-ending injury where I tore my hamstring halfway up my pelvic bone and was not able to fight anymore. So when that happened, I can look back now. At the time, I didn't know it, but when I can look back now and I can clearly tell you that I became pretty depressed, and I'd never experienced depression in my entire life. And while, Taekwondo was never gonna make me any money, it was never gonna, there's no big career in it. It was just something that I'd done it was my goal, and I've always been a goal-oriented person. So when I lost that, in other words, my body basically said, "Look, sorry, it's not happening, whether you like it or not." I kinda lost focus of everything else in life. I stopped going, stopped caring about school, stopped caring about, becoming a doctor, and I remember calling my dad walking down Neal Avenue in Columbus, one night, and I'm thinking I'm just terrified of what he's gonna say, but he picks up the phone and said, like, "Hey, I've decided I'm dropping out of the medical program. I'm gonna do something else." And he says, "Well, what are you gonna do?" And I said, I have no idea." It's like I've thought about software, I've thought about pharmaceuticals because I understand both, but he says, "What about being a financial advisor?" And I kinda stopped for a second. I'm thinking, "Why in the world do you think I've been taking biology and chemistry. Why in the world do you think I'd be a good financial advisor?" And he says, "Well, you've got that virtual stock exchange account you're always messing around with. You're really, really great with people. You're great, at communicating. And in that business, the numbers world, there's not a lot of people who are good at that side of the fence. There are kind of lots of good numbers people, but not a lot of good people who are savvy when it comes to communication and teaching. Helping people to understand things about their portfolio." And he says, "So I think you could be," and I'll never forget this. He says, "I feel like it would be just like doing surgery, except you'd be diagnosing financial problems and doing, maybe not emergency surgery, but you'd be doing some sort of having your patients on the financial operating table." And so I looked into it. He introduced me to his financial advisor up in Cleveland. I came back down to Columbus, went to a seminar, and I thought, this national brokerage firm said that they would hire me out of the gate. It looked interesting, and I thought, why not give it a shot? And I fell in love with the career literally within a couple months, and it became an obsession. And so here we are, 23 years later, and I've got a few businesses actually, but the main company, which is Libertas Wealth Management Group, I've got almost 300 clients, business owners, retail clients, all of which are like my extended family. I've got staff that are wonderful. I love them. I think they love me. So I kind of full circled. I kind of have everything that my dad had that I always wanted when I was a kid. It just looks a little different. It's not a medical practice. It's a financial practice. But that's kind of how it all happened.
Yeah, that's a wonderful story, and thank you for sharing that. For my own practice, and I think there are maybe in that sense some similarities. If you look at the surgery part versus the financial advisory part, so to speak, I think the commonality is the lifelong impact. Right.
Sure.
At least for me, it's one thing to say, okay, and I started out initially in consulting, coaching, and those kind of things was my first business before I got into this real estate investing part and made it a separate business. But the real big difference was that the impact on the business side was very temporary. I kept telling my wife, it's weird, a new client company hires me for some project that they want me to help either do a strategy or fix an issue or whatever. And I go and I look at this common sense, I find some efficiency opportunities, stuff like that. And it has impact to what they want. And they get hired like 6 months later, a year later with another company. And they have the same thing again. Now, if you have it 2 or 3 times, that's one thing. But I did this pretty much until COVID hit and you couldn't go anywhere anymore. And so that was almost 15 years. And the longer I did it, the more I kept telling my wife, it's weird. I mean, these companies are even in the same industry. There are people that have basically moved from one of the early ones that I worked with to the ones I'm working with now. And they asked me to come because they knew me from before. And they're still not implementing what we did,
Yeah.
right? Versus when we're looking at what you and I are doing now, if somebody gets their stuff in order, then you're basically refining and adding and maybe, reviewing and stuff like that. But when the structure and the strategy and kind of the intentions have been put in place, it has like really long-term impact. and we're working towards a goal. And I think this is, like fixing somebody who got injured. They will have that scar for their life, but if you did it right and did it well, then they will have, for the rest of their life, that positive impact that you caused if you did a good surgery. And, if it's a financial surgery, I think it goes in the same direction. So I think it's a good thing when you have both the knowledge and the empathy, right? That's
Yeah.
ultimately
No, I
the
love
thing
that you picked up on the analogy and you took it further. So yeah, well done.
Yeah, thank you. So when we're looking at the work and how it could be impactful or helpful for our audience to listen to, before we started recording, we talked a little bit about the generational aspect. So I wanted to get back to that and ask you what your experience is. You mentioned you're serving 300 mainly business owners. Maybe you can tell us a little bit what their perspective is and how you're helping them from this generational aspect. I mean, just to give the audience a little bit of an idea, one thing that I see more and more for people in my age group is that people have like this optometry business. And I actually tend to call these things a practice, right? Partially because it's not easily scalable, but also because the people want to come to your dad and they want him to help them. Yes, he might have a couple of assistants who do all the other ancillary stuff, but they want to go to the real guy. Kind of, I always use the analogy with a dentist, right? Like if you gotten used to a dentist, somebody poking around in your face, you don't want to say, or except when the dentist said, well, I'm going on vacation, but my buddy, he's also in the clinic, he can help you. I rather have the pain and wait until you're back, right? Kind of thing. So for me, that's kind of the distinction between a practice and a business. But that also means it's not always easy to then transition the business to somebody else who also wants to run it as a practice. So with that kind of backdrop in mind, what are you seeing there for like securing generational wealth, maybe building it for those who are a little younger, and some of the things that you touched on? Can you go into that a little bit?
Sure. Yeah, I'll answer that in two ways because I don't want to leave out the retail investor, your average non-business, call it, because economies of scale, there's a whole lot more of those people than there are business owners. So,
Yeah.
I'll start with them just briefly. You've got your non-business owners where, again, the majority of the population who, these days, unless you work for the state, unless you work for the federal government, you have a 3% chance roughly of having a pension. So your retirement is essentially going to be Social Security. And I don't know about you, but I don't know too many people who can live on it. So you've got to be pretty frugal to live on Social Security. So what ends up happening is you've got the average investor, business owner or not, starts planning for their retirement at 52 years of age, which is just insanely late, right? I mean, there's not a single person I talk to who doesn't say that they wish they would have started earlier. Everybody says that. But so on one hand, you've got people with, they work in the private sector, public sector. Maybe they are a teacher, firefighter, police officer. They got a pension that helps tremendously when it comes to, crossing the river and coming up on the other side, retired, and saying, okay, am I going to be okay? How much did I need to save? Did I save enough? Business owners are a little bit different though, because most people don't realize it's like one of my favorite quotes, I guess, in my personal life was years ago. And you and I were talking about 2011. I think it was right around 2011 that my wife and I, we play volleyball every Thursday night, sand volleyball year round. Still do it to this day. We're getting old, so we feel like we need to change our team name to Everything Hurts. But anyway, we're we're hanging out afterwards. We always go out and have some, pizza, wings, whatever afterwards. And one of my friends says, and as part of a conversation that had, was related, he says, well, it must be nice being your own boss, you kind of do whatever you want. And I was like, no, I don't think you understand. Like at the time, if you got 150 clients, I've got 150 bosses. It's not like I just do whatever I want. And by the way, I probably put in more hours than most people do, just because I think when you run a business, part of it is you have to work more, but the other part is you want to work more. It's your baby, right? You want to grow it. So when it comes to business owners, what I find a lot, aside from the fact that they're busting their butts, they're trying to grind it out, do everything they can to keep things moving forward, keep things on the up and up, in bad years, like whether it's the real estate crisis in 2008, whether it's COVID, whatever the crisis du jour happens to be, they're constantly pushing to keep things growing. And the biggest thing, to your point, that I think that they fail with, and I hesitated there for a second because I don't want to say fail because it's not intentional. They're not intentionally failing. They're not going to bed thinking about it. It's the whole working on the business thing, and everybody's heard that before. Working on the business instead of working in the business. But when I say working on the business, I'm specifically talking about growing the company for the purpose of being able to exit someday. And I think that the problem with a lot of businesses, keeping in mind, you call them practices and businesses, or you can call them lifestyle businesses versus big businesses. A lot of these lifestyle practices or lifestyle businesses that rely on the owner, that's one problem. The business, 5 clients represent 30% of their revenue. There's no continuity plan in place. The key employees, let's just say it's a small business and there's 10 employees, but 2 or 3 of them are key employees that if the business owner tried to sell and walk away and retire, that those employees would leave. So not having any kind of retention plans in place for those employees. Some people call them golden handcuffs. There's so many things that you can do from a planning standpoint to prepare to exit your company so that your company's worth something, and not just something, but worth a whole lot more on an absolute basis. And what a lot of business owners, again, don't even think about is in every industry, there are different multiples, and those multiples have ranges, high and low ranges. And the ranges have almost everything to do with the intangibles, not how many sales do you have, not what's your top line versus bottom line. Is EBITDA important? Yeah, of course it's important, but the intangibles determine how much, what's the multiple going to be. And when a business owner walks in, or another company, call it a competitive buyer, somebody in your industry, or an auction, a private equity buyer that comes in and looks at your business, goes, okay, well, how viable is this business? How attractive is it? What are my risks? So I think that I'm not sure if that's the answer you were looking for, but when it comes to business owners, whether and so you deal a lot with real estate. Another thing I'll see a lot is they'll own the building in which they do business. And when they'll sell the whole thing in one transaction where they should be selling them in 2 transactions, if they sell at all. I'd almost recommend they sell the business, keep the commercial real estate, and then kind of see how it feels for a while. And if they want to sell it, they can sell it. But if they don't want to sell it, they've got an income stream now, which is essentially their pseudo-pension, right? That they didn't have because they're a business owner, that would supplement their Social Security and all the other assets that they have that they can use to plan whatever's next, whether that's retirement, partial retirement. Some of our clients, they joke, they call it pre-retirement. So I think that's kind of what I'd say.
Yeah, absolutely. And you got very close to what I was hoping you would say. I totally agree on the last part for sure. And I think where you started your description is this point about 52 years or even older. Basically, there are 2 things I wanted to comment on that for the audience. Number one, if you find yourself there, you can turn back time, but you also have to realize that you basically probably subconsciously or unconsciously gave up on compounding, right? I know there's this term about compounding interest, but you can apply it to anything. Like if you had bought the en vogue thing 20 years ago was probably Amazon. You had bought some stocks in Amazon or whatever in your time 20 years ago was the thing that was big, but unproven. You had bought that and then kept it. Or if you were just to say, okay, as part of my business expenses, I fill in the number, $1,000 or $1,500 or whatever out of profits into something. Even if it didn't perform massively, but if you started doing that 20, 30 years ago and not at 52, it obviously would have a massive impact because of the time, not because of the performance as much. Most people get that wrong, but you can't turn back the time when you're 52. One other thing I made a little note because I mentioned it, and I'm always happy to use my own example. I was just curious because I don't know, you probably won't, but your clients may every once in a while get a notification from Social Security that you can click a link to see how much you would actually get. Like if you were to retire at 63, 65, 67, whatever. So I did that, and I think mine, because I only came to the US in 1995, flew for the Air Force, and then got into business, quote unquote, in 2001. So, I obviously don't have 40 years. So I think it's at $1,300 or $1,400. Now, obviously, like you said, you can't live off that. But what was interesting is I thought, okay, I give him a call, which by the way, anybody can do that. And I said, okay, I saw this, that I am eligible for that. If I were to retire at like 63 or 64, I were to decide that, how much would I actually get this number? And the guy says, yeah, you would get that number that shows you can move the little slider around and shows you how much you get at which age. I said, oh, that's pretty cool. And that would be a nice little added income. He said, oh, no. You only get that when you're making less than 22,000 a year.
Yep.
So I was like taking what I call like half a second take. He said, say that again. What do you mean? And he said, well, in my case, my retirement age is 67 according to their formula. So he said, until 67, if you have 25,000 or 30 or 40 or whatever thousand income, then that is basically 1-to-1 deducted. So you might not get anything from Social Security, which I'm only bringing up because number one, I was so shocked about this number of 22,000. That's like less than 2,000 a month, just so for people to realize. And how many people do I know, myself included, who all said, for me, retirement is not cold turkey. I'm working, 50, 60, 80 hours a week. And then I, like you call it, cross the river, cross the bridge or whatever. And now I do zero, no more income. And then I can get 100% of my Social Security. And part of the reason I wanted to bring this up, since you raised it, is the younger anybody is listening to us right now, the further this age is going to go into the future. Right. So right now, for me, they said it's 67. I don't know what it would be for somebody who is 40 right now. It's probably further. And if you just look at the financials in general, if you look at the numbers, we have $35 trillion in debt right now, $1 trillion in interest payments per year. So is that going to get much better? Well, I don't see a future where we really pay this back. We might get a better economy in the future or whatever, but the amount of money that all the people aging, like my generation, baby boomer generation, we're aging at 10,000 people a day retiring, at that 65, 67 retirement age. For more, another 10 years or so into the future, that huge bunch of people who's also most likely going to live longer than our parents did.
Oh yeah,
they all want Social Security, and I think the latest thing, and we don't need to dive too far into it, but latest numbers were like, I think 2032 or something like that. The fund is empty in the current way it's structured. So this notion to say, well, I'm going to retire, but that doesn't mean I do nothing anymore. Well, if that nothing anymore that you're doing is getting you more than $1,800 a month, you basically, any other amount above that is 1-to-1 deducted from your Social Security, right? So, which goes back to what you said at the end of your response. Don't sell the house or don't sell the building, right?
Yep.
Because it's also, and this is where I want to build that little bridge to your expertise, that's not the same kind of income that Social Security is looking at. So maybe we can jump into that and say, okay, why do they deduct if you have like a greeter job at Walmart, to make it extreme, and get like $1,800 a month versus, and I don't know how much they make, by the way, versus having a building that you used to have for your practice or your business that you now have and don't use it yourself anymore, but you have tenants in it. Can you go into a little bit like these different incomes?
Yeah. I mean, it's again, you got your retail investors, some of which have, and especially where we live in central Ohio, Ohio, Columbus is the capital of Ohio. So what you get a lot of is people working for the Department of Education, people working for the state government. But then you have a lot of teachers, police, fire, and thankfully, when we do their financial plans, generally speaking, we know that they've got a leg up above everybody else because of that pension. But for the private sector, whether that's an employee or a business owner, it's different. And for the average Joe individual investor that owns residential real estate, they might have Social Security, but they don't really, we put it up in the plan. It's one of those things you kind of breeze over because you're like, okay, I'm glad I have it. In fact, you'd be surprised how many people say, when we get to Social Security, they'll say, well, is that even going to be there? And,
yeah, right, exactly.
I always tell them, I'm like, yeah, I mean, if you're over the age of 40, it's going to be there. Whether they change the retirement date to 70 at some point for people over the X age, whatever X happens to be, it's possible they'll start means testing it at some point down the road where they say, basically they'll penalize the good savers at some point and say, well, if you saved really well, then you don't get as much,
right.
Which is so bad. But it is what it is, right? But for those people, they kind of breeze over it, but they're looking at their real estate income as their quote unquote pension, so to speak. And then from there, they're using their retirement assets, whether that be non-qualified assets, IRA, Roth IRA, old 401ks, things like that, to supplement that income. So let's just say we've got $70,000 of fixed expenses, and then you add up the Social Security, rental income, net rental income, and at the end of the day, we've got about $50,000 of income. Well, we just have a $20,000 gap we have to fill, and as long as we've got at least, I don't know, I'm going to do the math real quick here. If we're trying to take 20,000, I'll say that's pre-tax, so I'll say, or after tax, we'll say $25,000, and we'll say just 4%. If they've got $600,000 to $700,000, I think they're going to be fine. Just doing easy math. But if they don't have $600,000, that might be a problem. If they don't have any real estate, but they have $600,000, that could be a problem. So there's all these variables, and it's what the good news is. If it's not looking good, you can retire later, save more, spend less, or invest more. Right? There's options. It's not like you're screwed. There's lots of choices. And then when it comes to the business owner market, I think a lot of business owners don't have any problem working longer. It's like what you were saying a second ago, where people don't necessarily just want to pull the trigger, quit, and they're done. They go from working, full time to not working at all. Not to say that, your average retail investor, average Joe, doesn't also want to work part time, because we have a lot of clients that will say, you know what, at 60, I'm going to dial it back. I'm going to work part time, doing something where I'm getting, some companies paying for my health insurance, so I don't have to worry about the health insurance costs. And maybe I'm making $50,000, $60,000, $70,000 a year as opposed to $150,000, $200,000, $250,000. And I'm going to do that until 65 or 67, so I can avoid the insurance costs, because that's, big. I mean, that's a big cost for most people. And then B, so I can bridge that gap between now, call it pre-retirement, and 67 being full retirement, so I don't have to worry about the Social Security penalty, that one-for-one penalty you were talking about. Business owners, oftentimes they'll want to do something else. In fact, there's oftentimes business owners will say, I can't imagine what I would do if I wasn't working. It's like, and then the spouses oftentimes, doesn't matter if it's a husband or wife, it's the spouse will say, look, I don't want you around that much. So I think that in both cases, people are going to use, whether that be part-time income, real estate income, whether that's residential, commercial real estate income, and that's going to become their pseudo-pension at the end of the day. But you still have to have additional non-hard assets saved in order to produce that supplemental income to bridge that gap, whatever that gap happens to be. And we just talked about fixed expenses. We didn't talk about vacations and, fun stuff that people might want to do, bucket list items.
Yeah, absolutely. And one of the things in the context of business owners that I always find interesting, when you look at what the government, this is my interpretation, would like to see you doing, is to basically hire yourself in your own business. But I always challenge people that are especially solopreneurs or small business owners to say, okay, if you look at the cost of you hiring yourself versus what you could, if you were willing to use that money and put it into something that Adam, for example, could help you diversify and put away for the same amount of time until you go to the government prescribed retirement age. Even if you did it by yourself, but especially if you did it with somebody who is a financial planner like you, Adam, the outcome is just off the charts different. And maybe, I mean, I don't have the numbers off the top of my head, but you say, okay, I'm an optometrist and I'm basically, quote unquote, paying myself, I don't know, like 60 or 70,000 as if I'm like the hired CEO, so to speak, right? And I were to do this, 5,000-6,000 a month as give it to Adam versus give it to basically, having a salary that you have to pay income tax on, and then you have to pay FICA and Social Security and all this other stuff, what the difference would be, right? Like, because if you look at Social Security, I have basically for quite a few years that similarity, and the money that went in versus the money that is now supposedly potentially coming out is appalling. It's like, if I had taken that amount of money and give it to you, Adam, I would say, if you're not coming out at least 2 or 3 or 4 times better, then something went wrong, right? So,
well, I mean, just quick math, call it, what do they call it? Paper napkin math.
Yeah, right.
If you're, a lot of people don't feel comfortable saving right when they get out of college. They should, or if they don't go to college and they do a trade, which is even better these days, by the way, getting into electricity, plumbing, things like that. I have 2 sons, 14 and 11. And I've told them before, look, if you don't want to go to college, don't go to college. Get a skill, learn a trade, and then honestly, if you really want to shoot for the stars, then and once you learn it, start a business and start hiring electricians, hiring plumbers, and that's the way to go. But anyway, and it doesn't matter what you do. Point being, when people start their careers, oftentimes they're a little nervous to start putting money away because they haven't made any money, and they have all these necessities they want, whether that be a new car, place to live, things like that. Maybe go on a vacation from time to time. So let's just hypothetically say that most people don't really start saving in a 401k or saving for themselves in any way until 30. I'll just use 30 as an example. They should start earlier, but let's just say they don't. We'll use your optometrist as an example. They start at 30 years of age and they're able to put away, you mentioned $6,000 a month, right? If they put away $6,000
what would be a fair salary, I would say, right? Like if you say you had to hire your own position, how much would that cost? Yeah.
Yeah, I think it's a good number. It's paying yourself for, and I mean, one of the things I'm sure everybody's heard if they're listening to this podcast is paying yourself first, right? Before anything else. So $6,000 a month from 30 years of age until you're 65 years of age in an investment, whether that be the stock market, real estate, doesn't really matter what. Average rate of return of real estate in the United States is 5.2%. We'll say 5% just to make numbers easy. $6,000 a month from 30 till 65 years of age results in a $6.5 million nest egg at 65. That doesn't suck, right? There is absolutely nothing wrong with that. And if that 6.5 million, just do the math here real quick, only yields 3.5%, and that's it, you're making $19,000 a month.
Right, exactly. And with real estate, this is a perfect example, Adam. Thanks for pointing that out. Is in those 35 years, that real estate that you bought over those 35 years, if you were to put a good part of the money into that, would have no more mortgages on it. And the rental income, we're not even talking about the appreciation or the asset value, which would be then probably, 5-to-1 would be in the $30 million range. But the income out of $30 million of real estate that is rented and debt free, you would probably.
Who paid the mortgage? You didn't pay it.
No, the tenants. What I'm getting at is there is a term that I use, and initially I was a little hesitant because we always don't want to use swear words or stuff like that. But in this context, if you had a $30 million portfolio in real estate, or at least, let's say 20 million, the rest is in something else value-wise, you get to what I call bullshit money, right? Where you have all the toys and everything, and then you have to ask
Yeah.
yourself at the end of the month, what else could I do? Now, most people have good ideas for 6 to 9 months, but then if you have bullshit money coming in every month, you're
Yeah.
running out of stuff. And that's why it's called bullshit money, because you're buying stuff that really has no meaningful purpose. It's just because you can.
I think you got it right. I think Mark Cuban even has another phrase for it that's even worse than yours. But yeah,
Yeah, well, I don't want to get that extreme, but no, but I
I know
mean,
what you're
that's the
saying.
point, right? Like, to illustrate the point, to pay, if you're a business owner listening to us, you pay what you would think is a reasonable amount for the role that you have, which is also, by the way the IRS is kind of looking at it, if you really wanted to. Like if you have an S corporation, they would say, okay, show me that you the role that you have, that you're paying yourself. That's also sometimes, and I don't want to go down that rabbit hole, but when you make the decision of how you actually incorporate your business, that could be one of the driving factors to say, okay, do I just want to be a shareholder, or do I want to be basically the owner operator? And if you do that, then there is an expectation from the regulatory side that as the owner operator, you demonstrate that you pay yourself, which then invokes all this other stuff. And I'm saying this from my own experience because I did it for a while, and I was shocked when I had to start officially paying all the FICA stuff and so forth, right? Like what a waste of money.
A lot of fun.
So yeah, but it's the numbers get pretty big pretty quickly when you give it time. And that's why we're coming back to this. At 52, you gave up 22 years of those total 35 years that your example just had.
Yep. It's tough. It really is. Time is way more important than the money even. I mean, don't get me wrong, the money's important, but your time is way more important. I mean, we do this presentation for all the 401ks that we manage for the employees that work at these companies, where we explain to them that, if you start at a very young age, and I can't remember what the numbers are exactly, but if you start at an early age, I think putting away half the max in your 401k, that at retirement you end up with just over $1 million. If you start at 50 with $200,000 in your 401k and you add half the max, then you end up with something like 700,000 or 800,000. Mm-hmm. And even if you start at 50 with 200,000 and you max out your 401k, including catch up, you still don't beat the young investor who starts early, saving half as much. So time is absolutely the most powerful tool we have on our side. We just don't know it in most cases.
Right. And there's something, I really appreciate you pointing this out, Adam. That's part of, and you mentioned your own building that you're running your business out of. When you then combine the time with leverage, which is basically saying, okay, I put 25% down on a multi-unit building, like in our case, like for residential real estate, I know in commercial it's a little different, but in you can buy a fourplex, you put 25% down and let the tenants basically pay the 30-year mortgage. You have basically, depending on how you look at it, a 5-to-1 leverage. If you were to apply that to the example that you just gave, right? So it's your money, yes, that money that you put into investments with your help, Adam, obviously as a financial planning strategy, but then it's also other people's money that you can leverage, right? And it's not applicable to every investment opportunity, but I think it's a little bit underestimated how much difference that makes. If I put 20,000 and the bank puts 80,000, and to get the 80,000 back to the bank plus interest comes from someone else, right? Where I'm ending up when I get to retirement age is like off the charts, right? So
it is off the charts. It's off the charts, but I think the problem is that most people don't know how to get started first and foremost, and then especially when you compound that, no pun intended, by the way, with the fact that we're living in a much higher interest rate environment than we have the past 10, 20 years. I think that's where your company comes in and your website, and that's where you can help people out and kind of help them get started.
Yeah, exactly. And I think that's both our roles. And that's why we have the podcast. And that's why I'm so glad that we have you on the podcast. It's to say, you said you were just depressed when you found out that you couldn't compete anymore. Mm-hmm. Right? I think there's lots and lots of people that are maybe not to the level of depressed, but frustrated, to say the least, that they know they should do something, and they should maybe also realize they should do it sooner rather than later. But there is so much negativity and fear mongering in everything that streams into us on a daily basis that it triggers, in my opinion, a strong fear of failure.
Sure.
And, given the choice to say, okay, if I do nothing, yes, I'm not doing the best I could, but if I do something and it's going wrong, that's even worse. So what's really the solution? That's the message, and why I even ever started a podcast is, well, if you're afraid that you might make a mistake, then go to somebody you trust that can build a trusting relationship, who can demonstrate that it can be done with the necessary expertise. And you have developed, you have all these little 3 and 4 letter acronyms behind your name because you studied this stuff and you practiced it for 23 years. There's no chance that somebody nowadays comes from anywhere in life and says, okay, I'm going to catch up to Adam. It's just not going to happen. The same thing when it comes to the specialization in what we do with the Series LLC and the residential real estate investing. In that relatively narrow lane that I've been doing for 17 years now, first for myself and then for clients, you don't catch up when somebody has 15 or 20 or 23 years at a head start of you. But what it does is, it is hopefully, this is really my message, and I hope that you would, I believe that you would agree. We are here to help you overcome that fear and get started.
Mm-hmm. Yeah, I think
right?
it's kind of like the client is the hero at the end of the day, right? It's that whole story, the storybook. The client, we're not the hero. We're just the mentor, right? We're the Obi-Wan Kenobi and they're Luke Skywalker.
We give the lightsaber or whatever the other weapon is that they need to slay the dragon, or Yeah, exactly. Now, with that, if people listening to us say, yeah, okay, I get the message, I want to do it, I know time is important, it feels like it's running faster and faster every day. How do I get in touch with Adam so I can get started? What would be your answer?
Yeah, I think probably 3 ways. The first, easiest is just LinkedIn. That's always the easiest way to get a hold of me. If you go to LinkedIn, type in my name, it's probably pretty easy to find me there. The second way would be to go to our wealth management website, which is just libertaswealth.com. It's LIBERTAS, libertaswealth.com. That's for anybody. If you're a business owner, though, and you're looking to sell your company in the next, call it 2 to 5 years, then the other website would be elevateandexit.com. That's our business transition planning site, where we help owners kind of bridge that gap between where they are today and transitioning into where they want to be, so that they can have a successful exit, continuity. Their staff's in great shape, their clients are in great shape, but everybody's happy. It's kind of a win-win-win. So those would probably be the best 3 ways to get a hold of me.
Very cool. And if my old Latin serves me right, that has something to do with freedom, right?
That's right. Liberty, freedom, and independence. It's Latin. Yeah.
Yeah. Okay. Very cool.
Well,
thank you, Adam, for describing that. Before we close, I always ask 1 or 2 questions. So I want to ask you, if you could meet anybody, dead or alive, who would it be and why?
Ooh, I would love this. This is going to be obscure. I think I always have the same answer. I would love to meet Jet Li. He's the martial artist that was a multiple world champion as a teenager in wushu, kung fu. Obviously a movie star for many years, but I just since I was a kid, I always looked up to him, and I don't know. I kind of live my I'm not a Buddhist, but I live my life by a lot of Buddhist principles, I guess. And he'd be somebody I'd love to just sit down with for a full day and just hang out and talk and pick his brain and just get his perspective on life. Just because you see a lot of movie stars out there, people that are really successful, and they let it get to their heads. They let money change them, and he's one of those people that just didn't happen, and he kind of always stayed grounded. So I don't want to say I'm always actively trying to stay modest or stay grounded, but I'd like to think that I am. But I like to learn from people like that. So that'd be Jet Li, I'd say.
Yeah, that's very cool. I think actually there is something that I'm a little sad about, to be honest, looking at the environment, especially in the quote unquote Western world, that seems to be more and more running towards isolating ourselves from the Eastern world. And I'm not even anywhere close to a scholar or something like that, but I really appreciate a lot of the philosophical stuff. If you look at the Tao or any of those kind of things, if people ever wanted to read some of the things and also realize that there's 6,000 plus years of history behind it and really like profound. So I would love to see if we could use the image of the yin and yang for the West and the East, that instead of trying to pull the two pieces apart further and further and try to identify enemies all the time, it would be much nicer and I think beneficial if we bring it together and basically benefit from what the good things are of both, right? And so you just said you're not living necessarily Buddhist principles, but some of the philosophy, and I think that would serve most people very well. But the first thing I would encourage our listeners is you don't have to become a Buddhist or like a Eastern philosophy major or something like that, but I hope you can keep your mind open to things that are out there in the world and have been for a long time that are just different and worth exploring, rather than just saying, okay, we are the best in everything and we don't need anybody else and we don't listen to anybody else. Or like, sadly, a lot of my friends never even leave the country, so and explore anything else. So I want to encourage everybody, like you said, look into what's out there, and again, it's kind of interesting. It's similar to what we spoke about with money. You cannot get your time back. Like this Libertas aspect of freedom is also, and we are always striving in that direction, is to find a way to get to time freedom as early as possible. So you can use the most valuable thing you have, being your time, as early as possible for the things you really want to do, right? And so I hope we can and have today done a little tiny, minute little puzzle piece in that direction. And I want to thank you, Adam, for helping make that happen.
No, thank you so much for having me. This was a lot of fun, and I think we could probably turn it into a whole other podcast about.
Totally, yeah, that would be.
But you'll probably have to stop here for the day.
Yeah, absolutely. But that would be a cool episode talking about like the yin and yang of West and East, right?
I'm not so sure, and I'm an expert though. I just have.
Me neither. It would be two novices philosophizing about it.
See if anybody cares, right?
Yeah, right. Exactly. Thank you, Adam.
Thank you.
We hope you enjoyed today's episode. If you like a second opinion on your retirement plan or investment strategy, please head over to libertaswealth.com. This podcast is for informational purposes only and should not be considered as legal, financial, tax, or as a basis for investment decisions. Always consult a certified financial planner or a fee-only fiduciary advisor before acting on any ideas discussed.